All right, looks like we are preparing to live stream. Believe we are starting up here. My name is Brett Schafer. I am joined, as always, by Ryan Henderson. Today is Thursday, which means it's the Chit Chat Money Investing Power Hour, number 83. We're chugging along here, hitting earnings season. Going to be plenty to talk about. I think one that's going to be fun that had some. Basically, I wanted to talk about it because it seemed like there was a lot of interest about it on Twitter. Is Match Group's earnings. We also got some housing updates with this real estate lawsuit. Ryan has some interesting stuff on Zillow, as well as I forgot your notes. What else do you got, Ryan?
Solar, maybe a little bit of solar because demand apparently just fell off a cliff. So could talk about that.
Yeah, and the materials cost for those things have really gone in the wrong direction. Also, I wanted to talk about the Charlie Munger interview, as well as possibly the Druckenmiller interview, although I doubt you watched the Druckenmiller one yet. Maybe we could save that for another week. But did you listen to the Munger interview? If so, it could be fun to talk about.
Yeah, I did. I like when we do these the pod about a pod kind of thing.
That's true. It's always fun.
It was it
Um,
was I'll start by saying this about the Charlie interview. Just a serial interrupter. I kind
Charlie?
of yeah, I know he just
Oh,
doesn't
yeah.
care about what anyone else is gonna say, but like I felt so bad for what are their names? Ben and the other host. And like they would make it 5 words into a question. As soon as Charlie had any inkling about what the question might be about, he just started his answer.
I know he has not had the formal podcast training that we have, where basically, if you're recording something, you wait until someone finishes. If you're doing an interview for us in these ones, sometimes we interview or interrupt each other, but it does not make for the best audio when you're constantly just interrupting the other person. But yeah, maybe let me check that one out, or excuse me, tweet out the link to this. We did join a little late here, although I think that's why we had some people hopping on early. Thank you for Mr. Dapper, Capper, and Tyler for joining. One of them says, appreciate the transparency on the fun. Great podcast episode. Yeah, check that episode. We did kind of a post-mortem. We decided to close out our investment fund and just focus on the podcast going forward. We did a full hour discussion on that. Should be right before this one. And I should reference that last week we mentioned that we sold Sprouts Farmers Market. The reason we did that is because we're transferring the money outside of the fund to, our personal accounts again. So
We sold
we changed our
everything.
opinions on the business. Did end up being good timing,
We sold everything,
but
right?
that's what I mean. It's because we sold everything. So that's when we mentioned that last week. Someone had a few people reached out about questions about that. I just want to clarify. Has nothing to do with the business, just kind of timing. We're in a weird limbo period there. But let's get into it. I think it'd be fun to talk about the Munger interview first, since it's on top of mind. I'm going to tweet out the link and we'll get right going here.
Yeah, as Tyler says, it's kind of podception when we talk about another podcast, but like always great content, still incredibly wise, especially for someone that's about to turn 100. But I just the interruptions make it kind of hard to listen to be honest. And I did find it funny that there was like that third guy. I don't know who he was. I don't know if he's like Charlie's like right hand man or something that would just like he would hop in and Charlie wouldn't interrupt him. You know who I'm talking about? Like that background guy that would just ask questions. I was like, I don't know who he is, but I'm glad he's there because it like he was like the glue for that whole show, like stitching the whole
Yeah.
thing together. As far as content goes, I thought it was pretty I thought there were definitely some funny tidbits. I liked when they asked about like whether or not the hot dog thing was real, whether or not uh what's his name told told him not to raise the price of the hot dog. I'm sorry, my Costco history is not up to par with most people's. Uh and Charlie's like, I don't know. I don't think that's really a board matter, a board meeting matter. So yeah, it's probably fair. I'm trying to
Yeah.
think of other ones. I didn't really take like any mental notes. So and any other content that you thought was like good from the pod?
I thought it was interesting. when they talked about, he was pretty frank about John Malone and he said I didn't like his manipulations, which I think
The
he can speak
great
frankly about.
manipulator, right? Isn't that what he called?
Yeah, and I don't think that is too far off because if you kind of look at the results of some of that, yeah, there's a lot of history of him doing things that may or may not have been uh, selfish or misleading to some shareholders. I'm trying to think of the other stuff.
I
I
do
mean,
think
he talked his book a lot of yeah, like the same stuff that he usually talks about.
BYD, China.
BYD. He said BYD was the guy's a genius, which I guess makes sense given how fast they've been growing. Yeah.
Yeah.
I don't know.
I thought it was kind of interesting that they also asked about like, do you think you and Warren would have done better with a little leverage kind of thing? It's like, yeah. And they're like, do you think you could have blown up? He's no. Maybe you should have.
Yeah, that's true. That is interesting how they could have been twice as rich or something if they decided to use some leverage. I mean, they could of the last
Like what
10
leverage
years,
though
they could have
could he
taken out a
use?
lot. Well, I
I
mean,
mean, I'm sure
for
they
example,
didn't they raise some debt in Japan, like denominated in the
well,
yen or something like that?
yeah. I mean, of course, and they've done that from time to time, but they could have raised tons of debt over the last 10 years and just plowed money into buybacks and run not as conservatively run. They could also have been doing that uh, throughout time, but I'll let the Berkshire experts kind of maybe analyze what they mean here in that regard. Got some other comments here from Andrew Marshall over from
Capital
the
mindset.
oh god, why, yeah, what, I always have it either mindset capital because there's another thing called mindset capital and then capital mindset. It's capital mindset, not mindset capital. Says we've had some pretty big interviews lately. Rick, CEO, in the Bear Cave. That is true. We got an interview with the RCI Hospitality CEO that came out this morning. I would check that one out. And he said, we have a question from Tyler. What did you guys think about Munger's commentary on power laws and investing and swinging huge when you get a good bet? Yeah, I think that's kind of what the talk is book thing. I probably heard him say that 10 times or read about it 10 times. He seems to hit that in every interview. He's definitely right there. But you got to be pretty sure it's a good bet. So I don't think you can say, hey, I've been studying investing for a year. I see a home run opportunity. Now I'm going to buy. And there's probably only a couple that'll show up in your life if you keep studying businesses. So maybe he's definitely right, but you got to be really into the investing game, I think, to have that strategy work for you.
Yeah, it is definitely like a thing a lot of young people fall into, where it's like, wow, this is such a great opportunity, especially if you invest in something that like drops in price. The thing I thought was a really interesting comment from him was when it's like, you might not realize it's like a sure thing until 5 years into your investment. Like you might own it for a while and then the opportunity doesn't become like a perfect opportunity until you're maybe 5 years in and you see something where the price has gotten disconnected from maybe the reality of the business. And I think we've had situations like that, like failures like that, where we thought, oh, this is a great opportunity, buy in size, and then we realize it's not. And on the flip side, we've owned stuff where we're like, yeah, we think it's an okay opportunity. And then 3 years in, you know the business a lot better. You've owned it for a while. You get more familiar with the ins and outs and kind of trust management more. Then if there's a price disconnect, it feels a lot easier to make that bet. It does discourage me from wanting to buy in size in anything because,
Right at the
well,
start, you mean?
yeah. And the thing is, he said like maybe you'll find 5 to 6 great ideas throughout your career or whatever. It feels like Warren's done it once every 3 years or something like that over his career.
No. I mean, his last good idea was Apple. Before that, his last good idea was
I mean, he said Japan.
um
He said Japan was like
that's
an
not
easy
that's
one.
not Yeah, but that's different. That's different.
How's
That's not
that?
like a
It's not just a pure equity traded on the US, but it's
no. I think it's different because he would say that the ones are like Apple, you know, See's Candy, Coca-Cola,
Amex.
essentially. Yeah, I think he's separating those out because Japan was more. I think those Japan holding companies were more of a standard, you know, value play, right? When
Yeah, but when it if I forget the term he used, but I think he called it like obvious or something along those lines. Like that's so
well,
obvious.
it's because they could take out 0% debt and buy the stocks with 5% dividend yields. So that's more of just an arbitrage thing, I would say. And then they appreciate it in value by like 100% in 5 years. But
I figure that's what he means by like a great idea, but the I don't know. It does discourage me from wanting to just because, especially in the 3 years that we've been investing, 4 years, 5 years, whatever it is, the learning curve's been so steep. Every time I think like, wow, I've come across something really good, I maybe need to check myself and just be like, yeah, maybe you're wrong on this. If you're only going to
yeah,
find 4 or 5 in your life, but
I think it was a good point when he said that sometimes you don't realize it until 5 years in, because when you own something for 5 years, you know it really well. You're going to know it better than almost anyone if you consistently follow it. It's not like you have to follow its every move, but if you just consistently follow the company, and then you can sometimes find a mismatch where a lot of people who don't follow it closely misunderstand the situation. And you just got to be confident in that regard. I think again, it comes back time and time again. It's probably because it's the only one that's really worked out for us. And in this regard, it is Sprouts Farmers Market for me, where people were misunderstanding the situation. I had followed it for a couple of years, and I was like, hey, I mean, that's not a home run, high moat business, but I think that example rings true for me. Where if I hadn't followed the business, I think I would have been in the same boat as kind of the Mr. Market there. But I had followed it for a couple of years, and I was like, oh, they're misunderstanding the situation, and the opportunity makes sense.
speaking of investments that you might not realize are great investments until a few years down the road, Match Group. Should we talk about earnings?
Well, do we want to hit some of these maybe questions first? What are your thoughts, just in reaction to Munger? What are your thoughts on his VC comments? He said they're kind of like scammers almost. I forget exactly what he said, but he did not have kind words for them. I kind of think of VC as a crapshoot and also somewhat as like charity back to society, where you're just funding a lot of people's high risk bets. So I don't think that was a crazy take by him.
I don't like a lot of VCs, but I like the concept of venture capital.
Maybe
It
I don't
does,
like the concept of taking a 2% management fee on that type of stuff when it's just illiquid markups, but hey.
yeah, maybe I don't like that side of it. I do like the idea of helping young entrepreneurs with early
Yeah.
money because it gets them off the ground, but there's maybe better ways to do it than the modern way venture capital is typically done. But
Yeah. All right.
I
Ryan
he
might
was
have
saying
gone.
something about it
Yeah.
like
You
only
froze a
needed to
little bit
be.
there. I don't know if everyone,
Can you hear me?
but yeah, I can hear you now. You might
All
have
right.
froze a little bit there, but I think people understood what you're meaning.
Whatever, let's leave it. Yeah, he kind of had he rambled on VC, so I don't remember. I mean, didn't have high praise. I remember him saying like at one point it wasn't needed, but like the industry. But I think it's hard for a lot of entrepreneurs to just get off the ground without capital. So I don't know. I think there's
Yeah.
certainly
And the last 10 years, there's been a lot of, I wouldn't call them necessarily scammers, but I think a lot of listeners know there's the ones that may have been, they're kind of hype guys, right? Like we all know that, and they get into trouble, and during the bubble, you can get into trouble, but I still think it's still great for the world. All right. Other question. You talked about the 5 year, uh, owned or every 5 year events. Do you think, or we have a question here from Tyler that says, do you think Berkshire is having another one of these with Occidental Petroleum? Maybe. I don't know the company well enough, but they seem to like it a lot. So probably wouldn't
yeah.
be when he bets heavily like this. I wouldn't it probably pays to study closely.
Yeah, and I used to always think like, how hard is it really for Berkshire to get into positions? Because I remember they always talked about like liquidity constraints with a lot of these stocks, like they can't even get in if they wanted to. And then you watch him build up the position in Oxy, and it's like this just slow grind of acquiring shares over what, probably the last year and a half, right? I don't know if
Or
he's
maybe
still doing it.
longer. I don't follow it that closely, but could even be longer.
I mean, it'd be nice to have that much money, but that would be a little annoying to like, you're like, yeah, this is a good idea, but it's going to take us 2 years to get a position. Like
Yeah.
that part would be frustrating.
Yeah. And he said I forget the person's name, but they talk about the trader they have. So they have, I think, a dedicated guy doing this type of stuff that basically implements all the trades for Buffett and the team. And I think that's quite interesting. That guy would probably be a fascinating person to interview. That guy, especially after Buffett passes on or something like that. That would be, I think, a fantastic interview. So we're not going to be able to probably get that interview unless we somehow get to be a giant show over that time period. But hey, the acquired guys, Patrick O'Shaughnessy, if you are listening somehow, I would that's a guy to go after because I would love to hear his thoughts. But
Here's
I think that's
my
enough unless you have one more thought here.
here's my conspiracy. Todd Combs, 2 recent interviews, public interviews, never did those prior. Charlie Munger, podcast. Are is Berkshire the new podcast promoters? Are
Yeah.
they the promotional company that's running all these podcast interviews to pump the stock?
Yeah. I don't know. There could be something scammy about them.
Do you think
I don't
Buffett ever
know.
does one of these?
No. Well, he only does it in a crafted situation, which is with the journalists he trusts a lot. Becky Quick is probably the only one left right now. Essentially, he does the interviews with her, and that's it.
Yeah, I can't think of anyone else. You don't think Buffett's going on the Joe Rogan podcast?
No, although
Did
people
you,
say that would be like awesome or whatever, and I don't. He would ask the wrong questions. I would much rather have him on Invest Like the Best
yeah,
or one of those type of shows.
I think it would have happened by now if he was going to do it. But the
They probably
let's
reached out. I like to have him on a business breakdowns. Let's get him on right one of those where they bring on those guests. Where he's like, we're breaking down Geico. Welcome in. Today we're breaking down Geico when we have special financial analyst Warren Buffett.
that would be
But yeah,
nice.
let's talk. Let's talk. We got a lot of topics today, and we're already 20 minutes in. So
Match group.
match group, yeah, I think that's fun. I'm curious. I threw out quite a few tweets on it, and a lot of people had varying thoughts on the report. And I thought it was quite interesting to see everyone's opinions on it. So I'm curious your thoughts because for any listener, we haven't talked, I don't think at all about it yet.
Now, so mixed bag this quarter. Hinge, we can talk about quickly. Wonderful quarter. They are growing in influence throughout the world very quickly. Record downloads, and I think they might even surprise management with how much people are willing to pay. So I think the ARPU might be higher than or management's expectations for Hinge, and they're really not even turning on the monetization lever in Europe, from what I understand. So it seems like we are poised for a pretty good 2024 fiscal year for Hinge, which probably means 500 to $600 million in revenue. Tinder, though, the frustrating part is, okay, obviously it's not sustainable to lose to have download counts trend minus 3 to 4%, let's say, for the next several years and keep raising prices. It's not a cigarette business. I don't think they can just
Yeah.
do that in perpetuity.
And to be fair for people when they maybe have read the call, it's not negative downloads because you can't have that, but it's like the amount of downloads per day or per week are a little lower than they were. So their funnel of inbounds
Year over
is
year,
decreasing.
download count is down. even though it's a funny way to word it. It's
Yeah.
declining. The I wonder if it's fixable. So this is kind of the interesting thing because it's a good example of an investment where you get paid to make decisions in uncertainty. And with Match Group right now, I don't know if Tinder's going to fix the user issue. Like, I don't know if they're going to be able to make it where people spend a little more time on the bios and suddenly filtering's a little easier and they kind of fix this scale issue that they've been running into. If they do, this is going to be a good investment. It's going to work out well. They're going to print well north of $1 billion in cash flow annually on an $8 billion market cap. And they're probably going to buy back. They said 50% of their free cash flow, but I'm guessing if it stays around here, it's going to be more like 60 or 70%. So it's kind of one of those where it's a toss up on what happens with Tinder. But I think at today's price, you can get a decent return even if Tinder downloads do continue to decline a little bit.
Yeah, and I think it's just a good bet. Like there's some like obviously there's a chance that Tinder doesn't turn around. I think the main concern for me is the minimal disclosures among active users on Tinder, where people are concerned about the payer stuff, and rightfully so. Over the long term, payers matter, but it's only one part of the equation. They raised prices by 50% in the US to catch up because the old management team was either afraid or inept or whatever happened, and they just brought their prices on par with Bumble, Hinge, some of the other players. And they saw, I think it was 500,000. Don't forget I can't forget the exact number, but like a 10% decrease in payers in the US. I don't think that is the end of the world, especially as they added the weekly stuff, which had some volatility there. If you raise prices by 50% and your payers only go down by 10%, it's not the end of the world. But the one thing that does concern me is active users. Like if they gave out a disclosure that said either weekly active users or maybe even monthly is probably a fine number, given that people hop on and off these things, because daily doesn't really make sense. If they gave out some numbers that said, hey, these are either stable globally, I mean, especially in the US, I think US probably isn't stable. But if we talk about globally, if either active users were stable or still growing, I mean, I would be uber confident in this investment. But they don't have that, so that's the big risk for me, is that KPI isn't disclosed, because I think that's the big concern for me. Besides that, there's people calling for the management team to get fired. That would probably be the exact wrong thing to do, just because some of the problems stemmed from historically having a lot of management turnover. And now I think we need whoever it is. And I think this is a solid team as ever, given their mobile gaming background. You just got to ride with them for a couple of years, no matter where the stock goes. But yeah, I think it's a good risk reward here. A lot of people hate it, which I like. And you get a lot of hate for saying that the business still grows. And what's interesting is, look, like revenue continues to grow. And yeah, they're juicing stuff in the US, but if you believe what they're saying, it's because they just did a giant catch up in prices. Now, do you think, looking back on the price increases, were they too aggressive here? Should they have done it on a multi-year time frame?
No, I don't think the price increases has any bearing on the download count. So that's my concern. Like the payers, who cares? It doesn't, payers genuinely doesn't matter. If there's less payers on the platform, it doesn't detract from the platform value. If there's,
It's only 10% of the people.
yeah, it doesn't really matter. The fewer and fewer downloads, which I'm saying downloads, but you could equate it with active users. That becomes a problem. And it's obviously geographics, like specific to geographies, but that starts to detract from the platform. And maybe it's not even that, like, maybe all these users are moving to Hinge. Maybe they're moving to Bumble, Hinge, BLK, Chispa, Archer. Probably not that much on Archer. I do find it cool that Archer, within like 3 months of launch, is basically 2/3 of Grinder. already.
Yeah, yeah. From a
Download
download
count.
perspective, intake. Yeah, and downloads aren't exactly equivalent to users, but it's the most important intake. So it's a very important KPI. That's why Ryan's, for any listeners, is harping on it so much.
Yeah, it's frustrating, but I think you're right. Switching the executive team is not the right thing to do here by any means. And I would be actually, you know what, if they did switch the executive team, I would probably be reluctant to own the business here because it does feel like what we're seeing today, let's call it 5% declines in active users, is a guess in the US, let's say, year over year. That is from previous management errors. That is not from Bernard Kim not doing a good enough job revamping the product. I think the changes they're making today, I saw one of their recent ads where it's like, have your friend select swipe for you. I don't know if you've seen this. Like, have your friend swipe for you. It's like TV ads. I think that's a great way to attract women to the platform, which the easiest way to attract men to the platform is to attract women to the platform. So I think that's a great marketing tool or a great kind of advertising route. And it seems like they're making the platform safer, at least from what I'm hearing. So I think they're taking the right steps. Also, if they can really start, they talked about surveying their user base where they're going to start to ask questions like, hey, do you like whatever? Do you like drinking? Do you like, you know, asking all these questions to basically get some data on them so that they can help users filter their searches. That will help them kind of get on par with, I think, Hinge in terms of actual functional use cases, as opposed to just people going on there for 2 days and having so many people on the platform that it almost ruins the experience.
Yeah, and then having that data that comes in will be good for the AI matchmaking stuff as well, which is basically, it's not super complicated. You just have the right data and then surface the proper people for the other person. So yeah, I see no reason to sell my own shares, my personal account right now. I could sell at any time though, so this is just information. I
What
like the
would cause you to
opportunity.
sell?
So what would cause me to sell? Well, here's what they're saying today, that they're going to recover the download numbers given the marketing campaigns and given the revamp and all that stuff. And they expect that in 2024. They also expect Hinge to continue to be about a 40% grower, give or take. I think that's what would be my expectations for 2024. And then they also expect Tinder to grow about 10%, give or take, with FX, foreign exchange be a headwind. They also expect payers to stabilize. So conversely, if most of those things don't happen, I would be out. Because
Yeah.
if you look at the financials, the business doesn't look to be in the worst shape. They're going to have the cash flow coming in from the Google settlement, where essentially the free cash flow get a little bit of a bump, and they should have that. You had a nice chart on the conversion ratio that should recover. It has recovered from the litigation. I think a lot of the stuff's behind him, and they've, I think, improved greatly on their capital return strategy after I think a lot of people, such as us, yelled at them for about 6 months about how dumb they were being with buybacks.
Yeah. Do you think so the acquisition of Hinge looks brilliant, right? You pay $25 million for a business that's now generating $400 million in revenue annually. Great choice. Great decision of investment. Do you think the Hyperconnect X's out that? Because they spent 1.7 billion, right, on Hyperconnect?
Let's see how big Hinge is in 3 years, and then I would say it probably Hinge is worth way more than the Hyperconnect mistake, because if they continue on their trajectory, given the margin profile, if they get to that $1 billion revenue number, a $1 billion revenue dating app that doesn't need insane amounts of marketing to kind of keep a hamster wheel spinning is worth, what would you say, at least $5-6 billion?
Yeah. I just think about it like this. Okay. $7.5 billion market cap for Match Group today, 8 billion. Do we think they can generate $1 billion in free cash flow at least a year for the next 4 to 5 years? That feels very achievable to me. And if they can return a lot of that in buybacks, it's hard to see how this doesn't work.
Yep. And they'll probably pay down a little bit of debt given the interest rates. They kind of hinted on that. Yeah, like I said, I think it's a good bet. A lot of people are very pessimistic on it. And frankly, at this moment, I think that is a good sign. Now, is this one that you want to go all in on? No, I think it's a good bet and size accordingly if you like it. But yeah, I've been wrong on it so far. So it's kind of one
All
where I
right.
think a lot of it's gone down for so long that we're getting into the stage where people are capitulating and just hating it so much because of the price and they don't want to be in it anymore. And this is a lesson or another lesson, I'd say, in we should have put the stock on our watch list and waited for these type of moments.
Oh
And
yeah.
that's,
Yeah, that was a mistake.
yeah.
Okay, let's pivot because we can
Yeah.
talk
We
about
could
Match
talk
Group
about it
all
for the
day.
rest of the show, but yeah.
Zillow, I want to talk about real quick, and then this can bridge into our housing discussion or the news from this week. I'm just going to give some numbers, okay? And you kind of tell me whether you're surprised or not. Over the last 10 years, like if you're looking at Zillow in 2013, and I told you that Zillow, which has 50 million unique monthly visitors, which is huge, it's like the biggest real estate platform at the time, 50 million unique monthly visitors is going to quadruple its monthly unique visitors over the next decade. So 220 million, I think, monthly unique visitors now. Revenue is going to grow tenfold. And they will, like, what do you think the total return would look like on that? On a business that's
Yeah.
kind of like they're losing money, but they're not, the path to profitability seems to be there. If I told you they're going to 10x revenue and 4x users, what do you think the total return would be? I'm not sure what the
Yeah.
valuation was like, but
Yeah. And I wonder revenue per share. It's a bit of a leading question, but I would expect it to be up. I don't know, at least
yeah.
200, 300%, at least, even if there's valuation headwinds and dilution headwinds.
Zillow's total return over the last 10 years is a whopping 30%. Let me actually, it might be lower today. I think they're down 5%. Zillow total return 10 years normalized. 30%. Okay. I want to do market cap though, because this is kind of interesting. They have added original 10 years. They have added, it looks like about maybe $1 billion to their market cap in the last 10 years. Maybe less. They have spent roughly $5 billion on acquisitions. It's such a okay. This quarter too, they have not generated positive earnings per share in 10 years, given
Really?
nothing to shareholders.
On a trailing on a trailing 12-month basis or something like that.
Yeah.
Maybe one quarter was positive.
Yeah. Not a single annual year of positive EPS. And this quarter, after a bunch of pointless acquisitions that obviously have not driven like per share value because we're still in the same place on a negative EPS basis, they decided to spend $400 million on some real estate CRM called Follow Up Boss with a potential for another $100 million earnout. So it's $500 million. They aren't generating any money. They're spending $500 million on these freaking acquisitions. I am
Well,
blown
if you've seen,
away that
I
Rich
mean,
Barton is still in there. It's for
yeah,
such a useful platform. This has been like one of the primary examples of wasting shareholder money.
yeah. And he does talk a good game. Shares outstanding up 97% in the last 10 years. That's a major headwind as well. I'd say that, Ryan, real estate CRM, maybe they just saw some of those Salesforce ads and said, wow, it is the age of AI. Thank you, Matthew McConaughey. We really
Salesforce
need
is the
this.
real estate CRM.
I know,
They
probably.
are.
Yeah. Yeah. Yeah.
You don't need
They
another one.
probably are. Yeah. Zillow is a great case of, and this is where I think is dangerous when there's companies that we like, some we own, some we have owned in the past, some are on the watch list. It could be the likes of Spotify, Match Group, as we just discussed, Wix.
Great
You know that
platform.
boat.
Great tech.
Yeah, like the management team is important. And if they're going to be very undisciplined, that can hurt you even if they 10x revenue. I think a good warning, this is a good example, I think, of maybe why I should be hesitant to pay up for Spotify, because I still like the business, but I think you want a discount there for that management team. Now, I think Spotify's management team is a bit more disciplined than Zillow's, but I think that's one of those where you have some concerns in that regard. Honestly, Amazon's is a little bit similar. Honestly, I think Amazon's is a bit similar.
You know what
People
else?
love Amazon now because the price is up. But I do you agree or disagree on that? That Amazon is similar stuff.
Maybe I think they care a little more about shareholders.
Yeah, probably.
The other part is Zillow may be the number one company, best in class, top tier, best of anyone at making bad results look good. And they did that in an extreme way this quarter. You also will not find in any press release, earnings slides, or anything like that the term per share. You won't find it. You have to go to the 10Q, which is just disheartening.
Yeah, and I bet that proxy looks pretty disheartening as well. That's why I think that proxies are extremely boring. The only thing that matters in the proxy for me is the executive compensation section. And I've learned this after probably doing 100 of these, as that's my job for the not so deep dives. And the only thing within the executive compensation, because they're going to dot a lot of BS just about, we want to incentivize properly. Look at what their incentives are and look at what the hurdles are for those incentives and ask yourself, are those the right incentives? And I bet Zillow's are probably pretty bad.
Ask yourselves, are those the metrics I'm tracking? Do those, if I'm the shareholder, do those metrics matter to me? Because if they are evaluating their performance based on monthly unique visitors and adjusted EBITDA, and you as a shareholder don't get those, that they can't put monthly unique visitors into your brokerage account. They can't return that to you. They can't return adjusted EBITDA to you. If that's their metric to evaluate performance, you probably are not aligned with them.
Yep. Well, I think that leads into one of my topics, which is a fascinating case that came out. We're not talking SBF, although maybe we'll talk next week if there's a final decision. They're actually doing that today. So honestly, as we're recording this, there could be a decision that comes out from the jury.
Was just going to add real quick. I started reading the book Number Go Up. Highly recommend.
Yeah. Is that the one I recommended, or?
Yeah, I think you have.
I think I did. I think I may have been the one that recommended that to you. Yeah, from the guy that was the actor turned investigative journalist.
Yeah, and Gary Gensler had it in his background on the interview. You remember
wait,
that?
Is that
Gary Gensler was interviewed? And no, it's the one you recommended to me. But Gary Gensler was interviewed, and it had Number Go Up just in the background on a shelf.
Yeah, actually, I may have not. Yeah, I haven't read this one yet. I read the other one that was from an actor from the OC back in the day. But both are very critical, so I'm going to read this one too.
I'll say, if you were skeptical of the crypto market, if you were at all critical and it was kind of frustrating to you to see everyone loving it, even though you thought what the hell is going on, this is the perfect book, because the first two chapters, he goes to the Bitcoin conference in Miami, as like just like an onlooker. He's like, what on earth is happening right now? There's some
Oh
really
yeah.
good anecdotes from that
Yeah.
whole conference.
I'm gonna read that one. Yeah, and as someone who follows that industry much too closely and probably just waste time because I like learning about it, it is worse than everyone thinks. But let's move to real estate. Collusion in real estate commissions. I thought, well, personally, I loved this verdict because I really hate the real estate leeches, as we might call them, the people that just leech fees and provide no value. But it was a super interesting case on selling costs and real estate agents. So the context is that a Kansas City jury found the National Association of Realtors, NAR, and others like them guilty in price fixing and collusion for commission rates on selling costs. The exact details may differ. I'd look up all the details yourself, so I'm not just going to list them off on here. The damages are $1.78 billion with a potential to 3x the payout to the winners, which is they call something like treble damages. I think it's just kind of the rule for a case like this is kind of the 3x thing. And I guess it's going to potentially lead to more cases, more precedent in the industry. Apparently, these costs, these selling fees that happen when you sell a home can earn real estate agents upwards of collectively like $100 billion in this country every year. And just for what this is when there's someone sells when there's a home that gets bought and sold, there's two parties. And then there's like, the agent, I think there's the buyer's agent and the seller's agent. Sometimes I've never done this, so I don't know. Some of this could be wrong, but essentially there's fees on both sides. The buyer has fees, the seller has fees, but a lot of times the seller pays a fee. And a lot of the times, apparently, these fees have been fixed and the jury ruled that it was anti-competitive. And I guess, and I did not know this, when you sell a home, the selling costs can be upwards of 5% to 6% of the home value. Did you know this?
Yes, but that's yes, and it's split between the buyer and the seller's agent. So like the seller pays,
But the seller
like
apparently the
typically
seller
like two
pays
percent or
for all
whatever.
this. But the seller pays for a lot
It
of the
gets
time.
passed to the sellers. That
In reality, it's 5 to 6%.
and there was stuff that was like there are people that said like, yeah, it's a cost, but it's going to be a lot costlier to try to do it yourself because you're going to make mistakes. I'm like, that is exactly what someone who wants to take the fees wants to say.
That's what the incentives would say. Well, it's
I'm
interesting
sure
is
there
that
is.
oh,
I
go
mean,
ahead.
they do provide there's some value. Like they having a buyer's agent and a seller's agent, at least you know someone is in your best interest. Can you hear me?
Don't
It
know
appears
what's
that
happening on there. I think you
I
froze for like
frozen.
10 seconds there. Yeah, Ryan's
Sorry.
got bad internet today. But I hope that was funny for everyone. Okay. Maybe it was mine, honestly. But
It might
what
have
were you
been,
saying there,
but
Ryan?
there's some value that's provided. I can't remember what all it was. I was going through the like Wall Street Journal had a decent article on it, and I mean, it's not worth 6% of the property, but or the transaction, but they do help in the process, especially with the buyer's agent specifically. Like if there's stuff that is not on Zillow that they can find you like a home. Like there's areas that maybe they can find what you're looking for a little better than you might be able to. They might know what to look for in like uh some of the quality checks on the house. But I would think if you're reasonably intelligent, you can read some of these documents yourself and just look up whether or not it's like common practice and whether it's safe. But I certainly don't think anyone should be paying 6% of their home sale price. Unless you're
Yeah,
paying
and
this, unless the seller's agent is the only person that can find the seller. Like if you can't find the seller yourself, maybe he's got like some network of like willing buyers that you can't access. I don't know if that's common at all. There's no reason to pay 6%.
yeah, there was some anecdotes, some stories out there about how someone tried to evade this and they basically got blackballed by all the realtors, which again is illegal. And I think the interesting thing from this case is it's not like, okay, eliminate real estate agents. They're basically said, and I think this is what the verdict was from what I was reading, is they want a free market here. They want the price to get set and not get fixed. And I think that makes a lot of sense. As a teaser, right after we record this, we're about to interview a housing expert, Lance Lambert, I think current or former editor at Fortune. He just launched his own thing. We're going to be interviewing him, and it'll come out in a couple of weeks. So we're going to talk about this as well on there. For anyone's interested in that, I would listen to that one as well. I think here's maybe for listeners to close things out here, and why these fees can be so destructive. Because I was thinking about this. I was like, does anyone truly make money in real estate except for these real estate agents? Because let's say you have $1 million home and you want to sell it within a couple of years, and you have $100,000 in equity, and you've probably put, after a certain amount of time, what would you say, $50,000 in renovations, upkeep, whatever.
Yeah.
You know what I mean?
Maintenance CapEx.
If you sell it and prices haven't soared, maintenance CapEx. Yeah, it's a good way to put it. Obviously, if prices have soared like they were from 2011 to now, then you'll probably make out fine because the price has gone up so much. But if you have only $100,000 in equity, you put in all that money outside of kind of, what you're putting in to pay for your mortgage, and then you sell the home, and you have the seller fee, which is $50,000. You make nothing. You have moving costs. You have all this hassle. Is it worth the time and money to try to trade up on these houses and stuff like that? It just doesn't seem, the juice doesn't seem worth the squeeze, unless housing prices are going up a ton every year, which doesn't seem, sustainable over the long run.
I think it can still be a good alternative relative to renting. Like if that's the opportunity cost you look at. But if you're looking at it as an investment purely versus like US equities over a 10-year run, it's hard to ever argue that you're going to generate better returns, because you got that seller's fee, you got the interest you're paying on and your mortgage. Now you're levered up, so it's going to juice your ROE. But there's also, like you said, the maintenance CapEx, which is maybe you're adding like air conditioning, maybe you're renovating the shower and the bathroom.
Something goes wrong, right? Something always goes wrong. Yeah.
And it's like, you're not just capital, you're labor. You got to mow the lawn. You got to keep up the house. Like, that's time you're investing into it. Now, maybe, the people love that, but if you're looking at it purely for the returns, the ROI, I don't think it's a good alternative relative to just an index fund. I don't think most people look at it that way, though. I think we do. We look at like, oh, is that worth it? But if you're looking at it relative to renting over the next 20 years, you're more than likely going to save some money and get a better return buying.
Yeah. But what's interesting is people talk about, oh, you got to build up the home equity and stuff. In that example I gave, you built up the home equity, but you put in those extra costs. Say those $50,000 is extra costs that you wouldn't be paying as you're renting. And then you have these seller fees on top of it if you decide to move. Yeah, if you don't move, probably work out fine. But you got to be patient. It's got to be the place you want to go. You have no flexibility. I think in the end, with renting, you get nothing, right? But in a lot of these cases, you're probably getting nothing as well. And there's downside risk as well. There's more downside risk. I think people
trading in and out of homes is tough. Right? Yeah.
There's a lot more downside risk.
Yeah. If you're trading in and out of homes, or if you're not sure on like job security or maybe location security that you want to be there for a while, I think renting is probably a good alternative in that case.
Yeah.
But downside risk, yes, certainly. But you don't have to, unless you're like a forced seller, you don't have to sell it at these lower prices. You can just opt to stay in your house, which I think most people today are doing, that were thinking about maybe selling over the last 2 years. And now their neighbor's house didn't go for as much as they thought their house was worth. And all of a sudden Like, yeah, I guess we're going to be here for the next 5 to 10 years.
Yeah. All right.
I
10 minutes
do
left
think
here.
it's
Oh, one
funny.
more thing. Okay.
I think it's
But
funny how many people say like once rates come down, I'll do something.
it's
Like it
inevitable.
like it's a guaranteed thing. Like, oh, I was thinking about buying a car, but I'll wait for rates to come down. Like,
Oh, you got a direct line to
what if
Jay
they go
Powell's
up?
future. Yeah, you got a direct line to Jay Powell's future brain, huh? Yeah. His brain in 2024. You got a direct line on what he's thinking.
Yeah, that people are. It's maybe just hope wishful thinking. All
If
right, what
the
else?
if unemployment stays low and GDP is still rocking, like they're not lowering rates. 10 minutes left,
You want to talk about
Ryan.
the Druck man?
Sure. Speaking of macro, we'll probably not have any strong opinions on this, but it was a good interview. If anyone ping us, we'll send you the link. I actually only watched some of it. Ryan, you said you didn't watch it. First off, I think he thinks he spoke about how corporations and individuals extended all their debt. Speaking of those mortgages, right? At low interest rates when they could. But he thinks one of the dumbest things he said this in the whatever 200-year history of the U.S. Treasury was said the dumbest thing they've ever done is not extended their duration at low rates while the Fed offered it to them.
This was when he was bashing Yellen, right?
Yeah, and he's Yellen was in charge at this time. Yeah, it was a discussion with Paul Tudor Jones, also another legend. I don't have that many takes on that, but it makes sense. I think I agree with him. I don't know. Makes sense.
I think I agree with Druck on pretty much everything, just because he seems really smart when he says it. So I'm like, yeah, that seems sensible.
He's a compelling man. Yeah. Okay. Other quote. He said, I think this is fascinating. Quote, for 30 years, I've never let my obsession with the deficit interfere with my trading. So he's kind of a deficit hawk. He doesn't like the federal deficit spending. Some people disagree on that. The reserve currency, modern monetary theory. I think it's Austrian economics, blah, blah, blah. What do you think about that quote? Separate the personal beliefs and gripes with how the country is run. And if you think a stock is cheap, buy it or commodity.
Yeah. I mean, theoretically, if we're levering up more and more, it's a better environment to be buying equities in, right? Like, I don't know how it trickles all through, but for the U.S.
If you
economy,
think it's going to
like
cause
you're going to get,
if you think it's going to cause a bunch of inflation, maybe you shouldn't get long gold and Bitcoin. You should get long Visa, MasterCard, Amex, and some financials that you think are quite healthy.
yeah. I mean, if credit is stimulus in a way, like it feels like it's good for the U.S. Treasury to a point, or for sorry, not the U.S. Treasury, for U.S. equities, and the U.S.
Yeah,
economy.
at least to
But
keep up with inflation. Yeah, if you think it's going to be highly inflationary. Yeah,
it's got to be hard though to like. I mean, Druckenmiller is different than a lot of people, just in that he's so active. It's got to be hard not to let your opinions on, because it's not just politics. It has weight on the economy. So if you think it has bearings on the economy, I'm surprised he hasn't allowed it to impact his asset allocation in any way.
yeah, maybe it has. Maybe it has. But I remember Paul Tudor Jones in the interview said basically it impacted mine and over the last 30 years, and it's been detrimental for me. Now, here's the other thing and this is why he's the legendary trader. I will admit before this, I do not know much about bond trading. I do know one thing though: when yields go up, prices go down. That's what I know. And he said, or Paul Tudor Jones was trying to kind of gas him up here. And they said back in 2021, late 2021, Druck told him that he was shorting the front end of the curve, which is basically 2-year bonds ish, is what he said. And he was calling it the greatest trade he's ever seen. Druckenmiller was telling Paul Tudor Jones this. Well, literally immaculate timing, because inflation was running hot. And then the Federal Reserve went on the fastest interest rate hike in history. And the yields on the front end of the curve absolutely skyrocketed. And I'm sure he made a fuck ton of money. Oh, sorry. Trying to be
No
family
swearing on
friendly
the
here.
show.
A lot of money. Yeah, we might have kids in the car.
Brady might be able to
A
bleep it
lot of
out.
money. Yeah. Apologies. We try to keep it. Yeah. But a
family
lot of money.
friendly. Yeah, I can certainly see that. The It's funny how looking back on it now, it was obviously hindsight 2020, but inflation was quite hot and rates had not risen. And if I'm not mistaken, it was telegraphed that rates were going to rise. And maybe that
I know.
priced it in, but
It wasn't apparent. It wasn't. Look at it. It's like, oh yeah, duh, short the 2 year. Duh. It's like, I guess no one
yeah.
looked at I didn't think of that at all.
Well, yeah, I guess we're not Drunken Miller, but I still think we got to get those like Chit Chat Money merch shirts of like Drunken Miller,
Yeah.
maybe.
And he's like, it's a cartoon of him chugging something.
Yeah, yeah. Our favorite man, Stan Drunken Miller. Um, okay, we got like 3 minutes, 4 minutes. Solar, Solar Edge, End Phase, tough reports. Basically, a whole bunch of cancellations from distributors and pushouts on or requests for pushouts. No one wants to install solar quite as much anymore. And turns out that there was kind of a massive bump in demand for this caused by Russia Ukraine conflict. So did you see this coming?
I did not see this specifically coming, but I have been wary over the last or cautious over the last couple of years about these renewables companies, specifically anyone exposed to wind and solar, because of what I've basically learned about of the cost of these things, the input costs, how it's maybe not as sustainable as people think, and it's people were talking about it in a Moore's law perspective, which didn't really make sense about the prices coming down and stuff like that. And we've seen it. There's been a ton of news reporting, at least from what I've read. I guess it's not a giant story, but how wind projects, offshore wind in the United States, has this cost have skyrocketed. So the estimated cost of all these things are just going up and up and up. I don't want to touch any in this market because it seems like the economics might be entirely subsidized. And do you want to really bet on government subsidies and basically where the political winds are favoring? Because we took out these political kind of favors that they're giving to the industry, how they're kind of pushing their hand on the scale to say go for wind and solar. And even in this case, the industry is not doing well at all. And I mean, how much value has been created in the renewable space? Like not much shareholder value. And if we take that off, we probably go much more back to fossil fuels and probably nuclear, I would say.
Yeah.
I just don't. I don't. I'm a big nuclear head, so if I think if people came to their senses on that, that would be terrible for this market. I don't want to touch renewables at all, at all. Too much supply chain risk too with China. I
Fin-
mean, come on, it's a terrible
Financing
store
costs
of
too.
stuff.
I mean, a lot of people pay for these with loans. A lot of
Right.
residential customers, finance these solar installations. So when rates go up, unsurprisingly, demand goes down. I
A lot of
think.
story stocks here. Yeah. Yeah.
Yeah. Anyway, 10:40 almost here on the West Coast. Do we want to call it or we got some time?
Yeah. Maybe we just plug some interviews. We got Rick CEO coming up or out today. We have Value Stock Geek, who is let's say, well, we've talked to him once. We'll call him a friend of the show. He's coming on to talk Tractor Supply. We've already recorded that. We got Edwin Dorsey from the Bear Cave discussing his short or bearishness on Hershey. And then today we're recording with a housing expert, Lance Lambert. So toss out, any of those, they'll be coming down the line. Just follow the show. It'll show up in your feed. And then we're also doing on our Tuesday episodes a fantastic, I think, set of sin stocks. I think we got a great balance there. We're doing British American Tobacco tomorrow, which in it, very interesting stock. Trades at a dirt cheap PE. We got MGM Resorts. We got Smith and Wesson, maybe the siniest of sin stocks. Diageo, and then Altria Group, where we're going to probably change up the format. We haven't finalized it yet, where instead of, since we closed the fund, It's basically going to be, since I kind of like Altria Group, I may be doing a pitch, and Ryan's going to try to poke holes in it, do some devil's advocates, stuff like that, different scenarios, kind of run through that, where essentially I kind of like the business, don't own it today, but have it on the watch list and would buy at the right price. Maybe the other person, Ryan in this case, tries to poke holes in it. And in other ways, we might flip flop that, do other stuff. So yeah, gonna be a fun month. Ryan, anything else before I close things out here?
No, Sin stocks I think that'll be a really fun one because a lot of them trade at reasonable valuations and have historically pretty good returns for shareholders in the long, long run. If not, I mean, British American Tobacco we'll talk about a little bit, but there's certainly some promise with a lot of these businesses as opposed to maybe some of the other companies we've looked at.
Yeah, a lot of operating profits being generated. Now, what they do with that, well, I think that's going to be something that we discuss. All right. As a disclosure,
also, last thing, I don't know if anyone's still listening, but we said WeWork might go bankrupt. They filed for bankruptcy.
Hey, we got something
bold
right.
prediction that WeWork might go bankrupt when they were like basically on the fringe.
Well, when we did the show, we said we basically ran the numbers and said, wait, they're going to file bankruptcy within a couple months. And hey, I wonder what happens, but we can discuss that whenever that finalizes and they probably get absorbed by SoftBank. But let's hit the disclosure. We are not financial advisors. Anything we say on the show is not formal advice or recommendation. I guess we're not general partners of a investment fund anymore, so don't need to talk about that one. But yeah, none of this is financial advice. Do your own research. We talk about stocks we may own on this thing. All right. Thank you everyone for joining in, and we'll see you next week.